Hey, everybody. Welcome to week 166. And we are high atop the BGW studios, and Jack is in the Shoemaker studios. And yes, Adam and I called each other and make sure that we were wearing black shirts today.
It's Halloween.
You got up at 4:30 to go swimming, and I got up at 6:30. And hey, wear your black t-shirt. No, I'm just kidding.
Hey, Gary, it was 3:45.
Oh,
Okay.
oh my gosh.
That it was 3:45.
I'm hoping I'm breathing at that time of the day.
All right.
Oh gosh. Okay, well, hey, we're going to be talking about what does a good partnership agreement look like? And we've got plenty of stories of what bad ones look like, or non-existent ones, or the ones that were in your head but not communicated on paper. It was all great until the crap hit the fan. So do you have any things from a Capitol Hill standpoint? I know you don't have your Capitol Hill background, Jack, but you may have something, because we've been off for a week, so.
Yes, so not really, other than what you hear in the news currently about ongoings. Was curious to read more about the president's trip to the UK recently and how that went off, and things that are I would say common knowledge with respect to that current college loans are not going to be forgiven or forgotten. Which my personal opinion, I don't really express my personal opinion a lot, is that, you knew what you were getting into when you went into it. And I had to pay my college loans and everything else. And so I was on the side of, I feel it's inequitable to basically say, yeah, never mind. And but I do also understand that it's a significant burden on people, and maybe they should have been given a little more assistance on the front end, and for whatever reason, maybe their applications were denied, etc. I have my own views on the whole Chapel Hill thing, and I call it the Chapel Hill thing of minority applications and kind of fixing that and denying that and saying it was improper, etc. As many of you know, I'm not, I might look like an old white boy, but I'm not. I'm half Latino and half Italian. So, but I understand both sides of it and the equities and inequities of both sides. So I will not voice my opinion on that, other than to say that you might perceive where I might fall in that continuum. So really, other than those things, interesting tennis matches going on. I'm happy that our American got as far as he did. I didn't realize he was as old as he is. It's kind of a late start, but who cares, right? He looks younger than he is, apparently. So that was fun to watch. But other than that, it's just kind of same as it was for the most part.
All right, cool. Thank you. We missed you guys last week, but hopefully you had a great Independence Day weekend celebration. We were off for the entire week, which was a blessing. But anyway, so it's good to be back with everybody here. So just a reiteration, hit us up with Q&A. You can harass us in the chat. And if you have something specifically about buy-sell agreements and what should you do to review what you've got, or how I don't have one, that's fine. We're here for that. We'll also address any other questions that you have from a tax standpoint, legal standpoint, or business growth standpoint. So Jack or Adam, you want to kick us off on this?
Yeah, it's more, I'll just share kind of the seem like a good, because really Jack's area of expertise. I was just looking to phone it in on this webinar, so I'm like, I know we talk about legal stuff. Anyway, Jack's just laughing in the background right now. But a lot of what I do and a lot of what Jack does ends up being having to interpret buy-sell agreements, partnership agreements, corporate bylaws, whatever you want to call them. I mean, they all kind of, it's a body that describes the same thing. And it all comes down to, hey, we all thought it was going good till it wasn't, you know?
Mhm.
And, you know, here's like, and I know that there's nobody that's on here right now, or that might be listening to this, as they go, that has never had this experience. You know, Gary, man, we got a great idea. We're out having a beer together. It's a good summer day. You know what we ought to do? You know, we ought to go into business, man. We'll make, you know, it's going to be great. You know, let's do it together, man. We've known each other forever.
It's
We're
gonna be
best
great.
friends. It's going to be awesome. We trust each other, right?
Absolutely.
Yeah,
That's gonna be great.
absolutely, right. Absolutely. Okay. Well, what do we need to do to get started? Well, we got to get a tax ID number. We got to let's go see a CPA. Let's go see. Well, you guys really need to spend some time talking about your operating agreement, is what I would say, as the CPA, or Jack would say as the attorney. No, we're good. We trust each other. Like everything.
That's gonna cost some money.
You know, it's good. $10,000 to do that. Oh, well, you know, no, either, you know, let's ignore it, you know, or alternatively, I know what we can do. LegalZoom will provide us with the answer,
Oh,
you
yeah.
know, or let's go with like the cheapest alternative, right? So time's moving on, you know, and we're not really making anything, so it doesn't matter anyway. But then all of a sudden we start making some real money, you know, and then all of a sudden stuff starts getting real,
Yeah.
you know, or you know, Gary, for whatever reason, Gary feels that I'm not pulling my weight anymore, and he's freaking sick of it.
Wouldn't be the first time, but.
Thank you for that. And he's just freaking sick of it, you know, and he's done with me. Like, he's talking to me about it, you know, we get in arguments, you know, and he's done with it. And and even if we decided, well, look, Gary, it was your idea, you be 51, I'll be 49. He's like, I'm done with it. I want you out. Now what?
Yeah.
You know, and there's, you know, and the answer is, I don't freaking know. You know, do you know? Because I can't follow this gobbledygook, if there even is gobbledygook.
Yeah.
So it just, you know, there's death and disability and stuff that's important too, but the key thing is hey, these are meant to be, you know, what happens when things go wrong, types of, I mean, they're corporate governance documents, but it's really meant to be, hey, what happens when things go wrong? Like, what do we turn to? We turn to the four corners of the document. You know, if we don't, the idea is, this is the way we govern the company, but hopefully we don't have to crack that open that often. But when we do, let's make damn sure that A, we have been following it, you know, and B, that we follow whatever it says. So anyway, that's my tirade, is that, you know, so often we see over and over again, either there was no agreement, but everybody thought we trust each other. You know, there's an agreement, but it's garbage, or nobody's opened it in years. You know, so it's materially out of date and people haven't been following it. And when you get to that point, you're screwed. So.
Oh, this is a hot topic, man. We've already got two really good questions that have come in here. So I'll read them in order, and it's a toss up for you guys. But first question from Kirk is, what's the best way to protect the company when an officer dies and his or her ownership interests are inherited by a spouse or family? Woo-hoo. Yeah, that's really a great question, and it's an important one. Then let's deal with that one, and then we'll deal with Matt's question here.
Yeah, I'll chime in first and then turn it over to Jack. I mean, that's the whole thing. I mean, hey man, it's all good. We're gonna be good. Gary dies, and all of a sudden, guess what? I have Jennifer as my partner.
Yeah,
that is the default. I did not want Jennifer for my partner.
Right.
She's a lovely woman, but she knows freaking nothing. You know, and at the same time, you know, if you're in a licensed business, Jennifer can't freaking own your ownership anyway. So we're screwed. I mean, we live example, we had a company that was dependent upon minority ownership certification. Minority owner died. Screwed. Anyway, Jack.
Wow. Yeah. Man, I hadn't thought about that one.
So we'll get into it in a deeper dive, but yes, absolutely, that happens all the time. And you would think that the governing document, the operating agreement, or even in a corporation, a shareholders agreement, or maybe there's a presumption that the bylaws have this language in it, which they typically do not in a corporation, that those are that, okay, everything's going to be okay. And it's gonna, well, what do you think is going to happen? Well, and there are options. And I will say, just as a first comment, that, and I think I've mentioned this before, so I'm very fortunate and blessed to have only 2 doors down from me, the guy who rewrote in 2014 the North Carolina Limited Liability Company Act. He's very modest and he won't take credit for it. He was the chair of the committee. And as we all know, when we become chairs of a committee, we do all the work. And we have help from others in the committee, but really, and he is of that personality that get it done right, don't just get it done. And so, or I should say, get her done. He doesn't talk like that. He's very, I talk like that. He does not talk like that. So, but he would tell you that what if you were to ask him what is the outcome, or what are the possibilities, or anything in relation to an LLC, he would, his first response is, what does the operating agreement say? The reason being is that dissimilar to bylaws and a shareholders agreement, meaning corporate law and the North Carolina Corporations Act, which gives you a lot of mandatory language, and it says, and it gives you some leeway to make changes in your bylaws and operating agreement, bylaws in your shareholders agreement. The LLC Act, the Model Act, that was then, Delaware is kind of like the leading edge, bleeding edge of LLC interpretation and corporation interpretations, as well as why you see a lot of bankruptcies in Delaware, because a lot of companies are domiciled in Delaware, and you have to file your bankruptcy petition where you're domiciled, so where you're registered in that state. And so what happens is that you have the differences in an operating agreement. You have more freedom of contract. You can put things in there that essentially, as long as they're not illegal or against public policy, they are okay. So the absurd, if you as an owner do not wear a yellow tie on the second Tuesday of every odd month, then you relinquish your ownership interests. Now, there's some equitable arguments about that. If your interests are worth $1 million and you happen to forget to wear your tie on that date. So, but you see the absurdity in that. But again, it would not be beyond trying to enforce something like that. That is, okay, maybe not mainstream contract language that we normally see in an operating agreement. So it's freedom of contract. And so we're going to talk about the various components of an operating agreement, which also would apply to a shareholders agreement. And so I see there's another question, so I'll stop there and then we can continue on with this discussion, so that essentially,
all right, good.
You guys can answer that question.
There's plenty on that inherited by a spouse or family. Same way with Keyman Insurance, that and how that's structured, and boy, have I learned that one the hard way. That's another story we can talk about. But Matt has a really good question here too. He says, hey, we learned big lessons in keeping capital accounts square. Will you talk about avoiding 50-50 partnerships? Ooh. I think we all have some stories on that one too. So
you want to take the capital count square, and I'll talk about deadlocks.
Yeah. So going back to the preceding question real quickly, I'll just give my 2 cents. I tell people when they're setting up, or if it's not clear, make sure that don't leave your spouse with this freaking mess, or your family with this mess. Clean it up to where you got a plan for if you get my partner, Jeff Klein, he doesn't say it this way, but he always, he uses his own version. But, at some point we have a conversation with the client, what happens if you get hit by a bus? Oh, I have a will, no, literally, like, who's going to go answer or get the mail, open the office, take over the company, like real.
Yeah.
Oh yeah, well, I guess my wife, no, because nobody's going to work for her.
Right.
Or my husband, oh, nobody's going to work for him. Like what?
Yeah.
So anyway, that's my 2 cents. But on the capital account maintenance, yeah, I mean, that to Jack's point, I mean, a lot of people that just use default, language, you got to change in a capital account, you got to change the ownership percentage, or, there are provisions that you can cure it, by making a capital contribution, which by default would mean you're not taking distribution. So like that's another area of like, hey man, if we're not crystal clear on how money comes out of this company and how we keep working capital, you got one partner who's pissed off and another one, guess what? I'm pulling out the big stick. Gary, you've taken too much money out. No more money for you. But wait a minute, I got to live. That's not what the agreement says. Either you put in $300,000 tomorrow, or I now own 70% of the company. That's what the agreement says.
I saw that one play out.
But what about gentleman's agreement?
Yeah.
And then on the 50-50 question, and I'm not being facetious, but I mean, I would say the answer is don't do it.
Yeah.
Unless you really, 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 really know what you're getting into and you're okay with it. And what I mean by that is it may be, fraternity brother, sorority sister, best friend, family member, but when you create a 50-50 relationship, especially in an LLC, now there are provisions in the Corporations Act that are more helpful in dealing with issues between owners that are deadlocked. One of the challenges of having more freedom of contract in an operating agreement is that if you don't provide for that, then a judge, jury, court, arbitrator is going to say, you got yourself into this. So short of your business partner doing something illegal or usurping an opportunity or something along those lines, then you're SOL. Do not use the court system to get you out of your mess that you willingly went into. And you should have had either figured it out yourself and understood what you're getting into, or you should have had advisors that would help you get through that, or you should have created a mechanism, whether it is that you take on the the ownership percentage to get a majority, or you create a tiebreaker provision, which is maybe a trusted person that would be neutral and would be the arbiter of the dispute. And so it would be 2 against 1, but you trust that person to make the right decision. And so that's something that would be in the operating agreement. You could have a provision that submits it to a neutral third party and an outsider, like a true arbitration provision for pre-litigation disputes, but that's expensive and you have to go through a process. And so, it's those kind of things that you don't really want to mess around with. But, we'll talk about more about the structure of the relationships and but the 50-50 thing is, it is one of those things where you get into it, you got to get yourself out of it. And there are ways to get around it, as I said, but don't look to the courts to help you resolve that unless there's bad behavior in the mix that you're alleging the other side did. And therefore, what you want done, which is maybe them to repay monies that they took out fraudulently or that they went on boondoggles or whatever it may be, that the court makes them put the money in. And then maybe a resolution of that is a dissolution of that ownership structure where you're buying someone else out and then you negotiate a settlement by a buyout. So that's another possibility to get out of a 50-50 situation.
Yeah. On that note, just, a statement that as a firm, I cannot think of a 50-50 partnership that we still have as a client. Meaning like they've either sold, somebody's bought somebody out. And that includes, myself, because I started as a 50-50 partnership. So they're just, it's not, it's not a great practice to have. And I think secondly, to Jack's point, and I really want to hit this home, Gary, this partnership agreement isn't working. You've been going on all these boondoggles and trips and all this spending company money for personal stuff, blah, blah. I'm mad at you. You got to go. Well, screw you. I'm not going anywhere, Gary says. And I say, then we're going to court, sir. And then I go to consult Jack, and Jack likely is going to tell me, well, we can try that. But at the end of the day, you've been putting up with that crap for years. So the way the court's going to interpret that is, you're okay with it. You deducted it on the tax return. You signed the tax return, Adam. And now you're saying that's not okay? Bad facts for me. So
I want to add one more thing onto that, because I've had a coaching client that was 50-50 partners. They were in each other's weddings. They were best men in each other's weddings. They go back a long way. It was the same sort of thing. This is a great idea. I know you, you know me, we trust you. We're like brothers. Yep. And then success hit. And it became apparent that one of the partners he was bipolar, and they didn't know. And he started making some really bad decisions. Hostile work environment in one of their places where he was located, different cities from the partner, and that he was creating sexual harassment, all that kind of stuff. And yet it was 50-50. And he's dealing with somebody that wasn't necessarily taking their meds the way they needed to, all this kind of stuff. So he wasn't really dealing with a rational person at this time, and he was stuck. And it took him a year and a lot of money with arbitration, but it was still like he had to thread the needle and get this other guy to agree, all right, these are the terms for me to do a buyout. And I mean, it was really painful to watch, painful to kind of help him go through as a sounding board. But I like your idea, Jack, and I think it's something that we ought to talk about a little bit more in that. So let's say that against all advice, I've either gone into a 50-50 partnership or I'm going into one. What are the kind of provisions that can be used, like an arbitrator, or have a board? You've got a board of advisors of a few people or some sort, or one person that's neutral, if you can find such a thing. It's hard with just one person, though, I think. What can you do to mitigate that risk? So let's go deep, man, into what you're talking about, like some practical guidance on what should be done.
Sure. So I would say that the more typical provision in that scenario is a standoff provision. In prior years, decades, it was maybe called a Mexican standoff provision. I don't really like that term, but basically it is, all right, if we have a disagreement and we can't get past it, then we're just going to acknowledge that we have to have a business divorce. So how does that work? Who gets to keep the company and who has to leave? Well, if I'm so upset that I want that other person out, then I am going to provide an offer to that person that they essentially can't refuse, because it is maybe, more than what the fair market value of their 50% ownership interest is. And so that gets them out. The hook is that that is what I'm willing to pay for his 50%. The second person, the offeree, gets to say, no, but I'm going to buy you out at that number. And so I have to be willing to accept payment of the same amount that I'm willing to offer to the other party to get out of the business and move on. Then you get into some of the details as to, okay, well, what does that mean as far as I'm going to pay you a couple $1 million. So my expectation is you're not going to set up shop. You're not going to use my customers. So there are provisions, which is you take the money, whoever takes the money is benched. You cannot compete. You have to go take the money and go on vacation or go do something else, invest it, whatever it may be. But what that does is a couple things psychologically. It basically on the front end, when you're creating this, you have to be willing to accept that if we have this issue, that I may be out of the business if I'm the one who pulls the trigger on that particular buy sell, the standoff buy sell. But you also have to be willing to say, all right, if I get enough money, I'm willing to walk away from this. So, and each side has to put themselves in that position of being the trigger person or the person receiving the offer. And then, so really the second person has more power than the first person, if you think about it logically, because they have a decision to make. And they can force a decision upon the person who initiated this process. And so that is the typical way of dealing with that, because what it does is it creates an environment of, well, let's establish what fair market value is for the business for the 50%. Let's figure out what is a sweetener of that. Or maybe you offer fair market value, but maybe the fair market value is not necessarily a multiple of earnings. Maybe you have a formula that brings in potential future value to present value because you're implementing some new technology, or there's some opportunity that's on the horizon, but you guys really cannot get along. Let's say that it's an opportunity that each of you has a different vision on how to implement to get to the finish line for this particular mega $1 million project. Okay, well, fine. I will butt out if you pay me enough money. And, and depending on how strict the rules are in this, is it that as soon as I get an offer that I get to hold the other person to that decision, or is there negotiating room? Like, okay, explain to me how you got to this number. And let's talk about the fact that, okay, if you're using a multiple of earnings, then, is it the right multiple? Where did you get that number from? Is it industry? Is it something just made up in your head? Because it's like, why not? Well, let's just take the number and multiply it by 4. Okay. Just because someone else got a multiple of 4 on a totally unrelated business, my buddy next door, whatever it may be. So it's those kind of things. So I would say that is the more typical way of dealing with that. I would say close behind that is having that third party come in and be the referee and choose a side, essentially. The problem with that is that first you have to find somebody that you really, really, really trust, because you're basically saying that you get to move the direction of the business how you wish and how you feel. So you're basically giving them veto power as if they were an owner, and they don't have ownership stake in the business, likely, usually. It could be that you have 50-50 ownership, and then, but for the most critical decisions, and maybe it's a short list, that the person who came into this business first, or who was built the business, who is the foundational person, if that's how this has turned out, is the one who gets to make that decision. So for example, we're going to sell the business 50-50, other partner says no. Maybe that the person who started the business, who then afterwards brought in the other 50% owner, is the one who ultimately says, okay, yes. What will happen in that scenario is, hopefully, is that the person who doesn't get to have the veto power in that particular instance will say, okay, but there have to be certain parameters that are met with the prospect buyer, which is fair market value, no minority discounts, no BS put into this formula kind of thing. It has to be a minimum, this minimum dollar amount, or whatever the other parameters are, or I get to stay employed for 2 years. And whether they use me or not, I really don't care, but I need to have this amount of income because I'm 63, I want to hit 65 and then actually retire. So this is early retirement for me. So someone's going to have to pay me my ordinary wages, even if I'm just sitting around doing nothing. So those kind of things go into the negotiations, and that is what shows up in an operating agreement. That's what shows up in a shareholders agreement.
Oh, that's a good idea.
Mm.
So we've had a couple good questions that have hit us already so far. If this is ringing anybody's bells, there's not a dumb question. The only dumb question is the one that stays in between your ears and you don't talk about it because I guarantee you somebody else is dealing with it. So any questions from your standpoint? I like that on. And so, Jack, let's talk about this scenario. You've got an operating agreement that you did a long time ago, or you went to LegalZoom or whatever, and you're really not sure it's all that great. And now all of a sudden you're thinking about it because of some of the stuff we've talked about already. Man, what should I do?
Yeah, so I'm gonna pull up and share my screen. And I pulled up, I extracted table of contents from a partnership tax treatment operating agreement and an S corp tax treatment operating agreement, which are very similar because they come from the same author, essentially, meaning here internally. But let's talk about kind of some common mistakes that occur. One is that you started this business by yourself. You're the 100% owner. You bring on someone, give them 30% interest, and you talk to your CPA and everything's good. Tax returns are filed appropriately, but you kind of forgot to go back to the document that governs the relationship, that very short document that you were provided by LegalZoom, hopefully not ever, and or an attorney that has put it together. But essentially a single member LLC by default, unless you choose something different, is a sole proprietorship essentially. And so you're not going to have language in there that you would see when there are more than one owner of the company, meaning buy-sell provisions, meaning management provisions, meaning what happens when you get hit by a bus kind of thing. And so you're not going to have those things because the getting hit by a bus thing is handled by your estate planning documents, because that's just an asset. You're 100% owner in this business. So your executor, administrator, or trustee will be handling that. As far as tax treatment goes, I mean, it's a pass-through. So there's you're not dealing with those kind of things except on your tax return. Another big mistake that happens is either towards the front end of the creation of the LLC, or subsequently when you make an S corp election. Let's say you've been operating as a partnership, or let's say you've been operating as a sole proprietor, single owner. You bring in someone else, and then your CPA says, so you go to Adam and Gary and you're like, okay, good, but let's talk about, yeah, you're an LLC, but let's talk about tax treatment and your options related thereto, and the pluses and minuses of remaining a partnership, which is the default for a multi-member LLC, or do you want to become an S corporation, or in some cases you need to be a C corporation for various reasons. Sometimes you have a foreign entity coming in, so there's all kinds of reasons, legal and tax reasons. But I would say choice of entity is more a tax driven consideration than it is legal. I can set you up however you want, but really you need to talk to your CPA on the front end before you start doing any of this. But what happens is that there's been a change in ownership or a change in philosophy to going from partnership to S corporation. And so at that time, there's no consideration as to that governance document, which is your operating agreement. And what it does is if it was a sole proprietorship, as I said before, single member, it's not going to have the language that you need in there for partnership tax treatment. If you are a partnership already and you go to an S corp, it's going to have language in there that says, again, remember, these are the rules governing documents of how the business is to be operated. And the governing document says you are a partnership. And when you receive money, this is what happens to that money. When you take money out as a partner, this is what happens. If you have a loss and you claim it on your taxes, this is what happens. So it's very precise for the most part. maybe precise isn't a good way of doing it. It's more restrictive. And there's more rules, I think, associated with that, because with an S corp, it is, and again, if I overstep something or simplify something too much, or if I say a wholly incorrect thing, please stop me. But with an S corp, it's okay, well, you're a 30% owner, you're going to get 30% of the net revenue at the end of the day, or else you're going to violate your S corp election. The money, the economics the money has to flow in ownership percentages, generally speaking. In a partnership, you can have all different kinds of things going on. And so, taking a step back, that's the reason why the LLC is the better format for the most part, as far as the legal structure, because you get these options on the tax treatment side of it. You get to choose whether you remain a default partnership, if you want C corp tax treatment, if you want S corp tax treatment. So it gives you more flexibility versus in the corporate standpoint, you're either a C corporation or an S corporation. So what happens is that you have now, you're an S corporation, you filed your S election with the IRS. Your CPA is treating you as an S corp and doing the appropriate filings and allocations and everything else that is supposed to happen. But now you have a governing document that says, hey, you're not supposed to be doing it that way. You are a partnership. So, now there's a problem. Now, I've had experience with blown S corp elections, and we've worked it out with the IRS because they're saying, well, okay, you were supposed to do it this way, but you said you were going to do it this way. The problem is usually the other way around, where I would say that you have a partnership operating agreement, and maybe you thought you were an S corp but didn't file it, or you have an S corp operating agreement that has all the right words in it, but there is an issue with the S corp filing, whether it was actually filed or not. And then what has happened over the past 3 years is your CPAs, not BGW, because they're more actually in tune with this and understand, like when they see this, it's like a bright red flag that says, hey, danger, danger, let's figure this out, kind of thing, right? But let's say other CPA firms who were not as inquisitive did not look at the operating agreement, and they have been filing this as an S corp, but yet you have a governance document that says you're supposed to be filing as a partnership. The IRS could take a hard line and say that, well, even though you've been doing the right thing and treating it, and your tax returns show that you were an S corp, you did file the election, you have a governance document that's supposed to be the rule book for your company that says you should be doing it differently. We have not had that harsh result occur. We've been worried about it in certain instances, but have been able to get around it, meaning getting the IRS to say, okay, give us a slap on the wrist. We've been doing it correctly. So in other words, you've been getting the tax money that you're supposed to be getting, and we will make a change, and please don't penalize us, because it would be a penalty. There's no interest involved because we don't owe them money. We've been paying them and I say our client has been paying them appropriately. So those are the two biggest issues that we see that go on. And so hopefully I have put into your thought process to go back and look at your operating agreement and see what it says. So why don't we take a look at what I'm talking about?
Yeah, and while Jack's bringing that up, I'll kind of a real example of what would be typical, going back to Gary and I. Gary, dude, you've done really well for yourself. You got all the money. You'll be the money guy, but we'll be 50-50. It'll all be good. So basically, I'll tell you what, though, as we start to make money, I want to make sure you get paid back. So, you get the first 75% of the profit until you get paid back, and then we'll split everything 50-50 after that, right? Sound good to you?
Sounds great.
All right, cool, man. Then we go to see Jack, who's our CPA, and Jack says, you're a partnership. That's ridiculous. You need to be taxed in an S corporation. Costing you way too much in FICA taxes, Does that sound good to you guys? Go ahead and switch up.
Oh, wow. Save some money. Yeah, sounds great.
You just blew your S election because you cannot do that economic split in an S corporation. because the IRS is going to deem it as you have two classes of stock, or alternatively, you did unequal distributions. So that's the kind of example of stuff that Jack's talking about.
Hey,
That's just so common, because
Yeah.
that would be like a normal discussion
Yeah.
that we would have. I want to get Gary
Yeah.
paid back.
yeah. So getting creative in that, like, there's got to be some ways, but you've got to be.
We have ways of solving that problem, but it just is. I just wanted to use that as an illustrative example of like the crap that comes up that you got to deal with.
Yeah, and I would say common, all it happens. It's not purposeful, inadvertent,
Right.
but it's just people not talking together as a team and figuring things out. So what you see on your screen is kind of, and I pulled this out of an LLC, a recent LLC operating agreement. And the formatting might be a little bit messed up because it was a cut and paste out of a document. I'm surprised that the page numbers actually came over because those are coded. So, let's just generally the anatomy of an operating agreement, right? Okay, so you have your general matters, who's your registry agent, et cetera. Then you have a section that talks about management. Here is the first kind of key component, which is who gets to make decisions and what happens when there's a disagreement. You don't want to tie people down that every single decision has to be made by all of the owners. You want the heavier decisions, the more important decisions to be made. So sometimes you'll see a threshold that says any decision that would cause the company to spend more than $5,000 in one instance or in several related instances. So like an installment contract or something along those lines, then you would have these listed out. And then there's some things that you might want to be unanimous: sale of the company, dissolution of the company. So those kind of things. So you see kind of ordinary business, things that require a majority or supermajority, and then things that might require unanimous consent on the management side of things. And then voting rights of members. So what can the members do? The fact that this section is kind of short leads me to believe, and I don't know this unless I go back, that this was a manager managed LLC, meaning that you don't have a managing member that is technically the manager of the company. You have separate managers, and it may be the same people, or maybe 2 out of the 3 people, that 2 or 3 members, the owners. Capital contributions, priority loans. So you have all this information regarding what happens with the money. So following the dollar that goes in, that has gone in as contributions, what comes in, allocations as far as net income and net losses. Again, you typically don't see this in many words, because net income and losses in an S corporation, it goes along the lines of ownership. So you're not going to have that level of complication in your operating agreement. Then, non-liquidating distributions. So what happens to cash, in-kind distributions? So things that are necessarily not cash, but maybe it's an asset that's been distributed. So other things, your typical who keeps the records, tax matters, that kind of thing. And then you get into transfers. This is what we were talking about before, which is how do you treat an incident of an occasion of transfer, which I want to get into. I know we're kind of running short on time, but so transfers, generally speaking, buy sells. I would say that buy sells the term buy sell is used generically by some. And for me, a buy sell means that section in the governance documents, and it could be a separate document, it could be an exhibit to the operating agreement that governs what happens with ownership under certain circumstances, voluntary and involuntary, which we'll talk about in a moment. Disaffiliation. So what happens when somebody, a lot of times what you would see here is that a member does something bad, that brings disrepute to the company, or steals or something else kind of thing. And so that's a trigger that you're out. And so these are the kind of provisions that talk about what happens with that. And then dissolution of the company, miscellaneous aspects of, governing law, jurisdiction, et cetera. And then you have, so this is, and I picked one that has this separated out as an exhibit rather than inline in the operating agreement. So you're going to see many pages of tax jargon, which is what happens with capital accounts, what happens book depreciation, book value. So you get into all these things that BGW knows in their sleep that I have to like, okay, wait a minute, I would not be able to tell you what, if someone said, oh yeah, 705 A2B, there are people in my firm that would know exactly what that is. I do not. I would have to have the IRS tax regulations in front of me to know that and understand these are not statutes. These are treasury regulations. Well, it's a mixture of regulations and the IRS code that are mixed in. So you'll see code sections, and then you'll see treasury regulations, which start like as 1.704, which is that references the actual code section in tax code. More tax stuff that you didn't want to know, right? Cliff Clavenish. And then you get into all this stuff that basically says, with respect to partnership tax treatment, these are all the rules that pertain to that. What we were saying before is this stuff, if you're not careful, if it remains in an operating agreement that has, and the company is elected S Corp election, this is a problem. Okay. In comparison to, let's see, where did it go? Here, is that 201? Okay. This one, which is corporate tax treatment. So if you remember, and if I could do side by side, I would, but you have things like maintaining an S corporation status. What are the things that you need to do? What are the things you cannot do? Disproportionate distributions, as Adam was referring to, allocation of profits and losses. Okay, maybe half a page, right? Because look at all this stuff. Non-liquidating distributions, so very shortened language, and you're not going to have the exhibit that has all of this tax treatment rules, regulations, statutes, et cetera, that you need to follow. So that is the anatomy essentially of two different types of LLC operating agreements. So let's talk about what happens if you get hit by a bus, right? So there are kind of two categories, voluntary and involuntary transfers. Voluntary is what you would think, which is, hey, offer you can't refuse from, and if I could do my good Italian Goodfellas or Godfather voice, I would do that, but I've kind of lost it. So, an offer you can't refuse. Maybe that, okay, that wasn't too bad, was it? Okay, better than dad jokes, I think.
That was pretty good. Yeah, it was more tolerable than dad jokes.
Okay, good. So, someone comes up to you and says, hey, how you doing? And hey, gives you a bunch of money and says, I'm going to give you a bunch of money to buy out this business. And you're like, bada bing, bada boom. All right, let's go. Let's do it. Right. So that's voluntary. Involuntary is kind of everything else, which is death, disability, the dumbass things you might have done as an employee. And so the worst case scenario that you can have, one of the worst case scenarios you can have in a company is have an employee that gets fired for doing something bad and not be able to pull that away their ownership interests. So they get to continue to be an owner. They get to continue to get the telemetry of the business, the financials, et cetera, typically, but yet they are very upset because you fired them, right? And so usually you have a mechanism that says if you lose your employment, you get terminated, then you have to give the ownership interest back. A subset of that is if we terminate you for cause, there might be a discount off of fair market value, or maybe it's book value of your ownership interest. If we kick you out for no reason, maybe there's a penalty to the company. Maybe it's 110% of fair market value. And then, we've talked about this before, the kind of the grid of 4, which is termination for cause, resignation for good reason, and then termination without cause, and then essentially resignation for no reason. And those typically have different consequences in the context of you getting your ownership interest or having to sell your ownership interest. So then you get into valuation issues, which is what is the business valued at? Can we come to an agreement? Hopefully, in my operating agreements, I build in a provision that is not necessarily followed in all instances, that says every year when you're going through the financials and setting a budget, let's kind of peg what the value of the company is so that we kind of know what it is, and you base it off of the financials. And then you have a stair-step process, which is, if we can't agree, let's see if our CPA can give us numbers and guide us through that process. And then we can decide if we can agree on a number of the fair market value, hence my 50%, 40%, whatever it may be. And then it stair steps into potentially arbitration. You pick someone. And then the worst case scenario, or kind of the end point, is that each side picks an arbitrator. Those two arbitrators don't arbitrate. They pick a third arbitrator. And then that third arbitrator, whatever he says is the gospel of what the business is worth. Variation of that is that each side has their own valuation expert. You have a third one, and now the average of the three is the fair market value, or the, maybe, some other formulation where one is given weight, the neutral one is giving more weight than the other. So again, other ways of doing that. But a lot of people don't anticipate those kind of things, and they don't want to think about those kind of things on the front end, because we're thinking about what in the worst case scenario might happen, and we need to plan for that. And then, Adam, if you want to hit on, and then there is, well, one more thing before you do is it a redemption or is it a sale? And what we do is we put it in right of first refusal to the company to redeem those ownership interests for various reasons. One is a lot of times the individual owners may not have the money to redeem it. And it is a lot of times a simpler process. If it is a purchase, so the other owners are purchasing it, let's say that the business says, we're not going to redeem it. It's better for the remaining owners to buy it. Then that is like a second right of refusal. If it is an involuntary transfer, that's the end of the story. If it's a voluntary transfer and neither the company nor the other owners want those ownership interests, then you can sell it to that third party for the price that was original. You can't mess around with the terms and conditions at that point and say, oh, well, now I'm only going to buy it for 90%, because that restarts the process of the rights of first refusal and second refusal down the line. But an important differentiation is whether it's a redemption or a purchase. And Adam, if you want to chime in on the tax consequences of that choice.
Yeah. So a couple things, first off, depending on the how the company's been operating, what type of company it is, this isn't industry specific. It's just that more industries lend themselves to favorable tax treatment than others, just based on retained earnings. But if it's a redemption, as long as you follow certain rules, there's a lot of times that it could actually be tax free to the recipient. So that's a good reason to keep the option open, is if I can avoid capital gains tax in the entirety of the transaction, that would be amazing to do. On the flip side of that, if there may be scenarios where I want to be able to redepreciate some of the assets we've already depreciated. It's called step up in basis, that would lend itself more to, and there's other people that I don't want their ownership to increase, that are going to lend itself more towards having individuals actually acquire the stock rather than the company. Because like when there's a company redemption, what a lot of people get confused by is it's not like, oh, we all got your stock now. No, it's more like when a big company does a stock buyback, there's just less shares or less membership units that are now outstanding. So everybody just gets reallocated based on the units that are left. Like their units don't go up or their shares don't go up. It's just now there's less. So my numerator did not change, but my denominator did. Therefore, my percentage changed by default. But those are the general reasons. I mean, we generally are gonna be aligned with Jack that it's like, look, if you can do a redemption, that really is gonna be the best route. But if you're not gonna do that, then you're kind of stuck with the individual buyouts. But people by default, it's funny, people by default think it's got to be Gary buying Adam out, but it doesn't.
And I also want to touch on something that you touched on a little while ago, which is, okay, so the amount of money that needs to be paid to someone, and you had said it in the context of people getting together and starting out a business and becoming very successful over the course of time. But what happens in the meantime, which is become successful, you don't put in all these things that we've been talking about because it's a very trusted relationship. So you don't want to think about the bad things, but something happens over the course of time. And so give you an example. 4 fraternity brothers get together. They start a business, very successful. They each multiple divisions in this company. And I think I've told this story before, but each one of the 4 has a separate division within the company, and there's some crossover, but the one fraternity brother is slacking off. That division is costing millions of dollars in bleeding because of bad management, bad decisions, distractions, etc. And they want him out. They don't have any of these provisions that we've talked about. So they come to me and are like, well, what do we have to do? And I was like, well, okay, you have to, I'm sorry, let me take a step back. There was a provision that had a formula in it. It was like, okay, let's just put together a formula that if someone wants out, you got to pay, X amount on fair market value, close to 100%. So they implement that formula and it spits out a number, 7-figure number. And they're like, well, I won't tell you exactly what they said, but you can imagine. They're like, WTF, this person has been going on boondoggles, company car, not regular car, Cadillac Escalade, family gets to get all these perks, right? And so it has to not spend for anything. Expenses, all meals, most meals as business expenses kind of thing, and doing all those things that I'm sure the hair just raised on both Adam and Gary's neck when I said that, because some of the things they've said today, I've been like, my blood pressure is like up here, right? Because I'm like,
to be clear, it's like, those can be perfectly legitimate tax deductions, but if I'm doing them and Gary's not, and I'm not telling Gary that I'm doing them, it's all about the fairness.
I lived through that one.
Absolutely.
So I don't want anybody hearing that I'm not for deducting stuff like that and making a business reason for it. I'm just saying if only one partner out of 4 is doing it, that's BS.
Yes.
Yeah.
So what ended up happening in that story was that they had to pay out that person a lot of money, and it took almost 2 years to get to the point to conclude that matter. Another example would be, and whether it is the that, let's say that 4th person in this example has someone buzzing in their ear. It's like, wait a minute, and this is actually what happened. Like, you're worth more than that. They treat you like crap. You're like the unwanted stepchild or something. You're not family anymore. Another variation of that is you have 3 guys and 1 female, and so you have someone buzzing in her ear saying, you know what, that's sexist. They're treating you differently because you're a woman, and you should go out and get. So put yourself in those scenarios. And so a lot of times it's outside influences, and when you don't have an agreement that is structured to deal with those situations, you're going to have to deal with that scenario of somebody externally interfering with the business operations of the business and the succession plan. So what I'm really saying is, your operating agreement is not only there to create rules for the operation of the business, for the buy sells, it's also to help avoid potential situations. A caveat to that is, and I know we're getting close on time, is that we also a lot of times will put a spousal waiver agreement that basically says that in the event that the owner and the spouse get divorced, that this is not going to be deemed marital property. The increase in value of that ownership interest is not marital property. It is the members' stuff, ownership, asset. That does not overcome the fact that if there is an imbalance in your equitable distribution in your divorce, that you have a $3 million asset that you want to keep, that doesn't take that off the table. There has to be a counterbalance of $3 million to the spouse, generally speaking. So I'm not saying that doesn't fix that problem. I'm just saying that there is a way to make sure that it stays with that owner and you don't end up being in business with that person's spouse potentially, or they're, in that scenario. So that is also an option.
Before we sign off, I'm kind of thinking we may have a part 2 on this one because I'm thinking of
surface. Yeah.
Partnership war stories. Oh my goodness. Like what could, because we've got them and we've lived them, but how to defuse the bomb. Right. So that could be an interesting thing. But final question that I wanted to get to that Matt asked, any good books on business partnerships?
I mean, I'll just give my 2 cents that I think Traction, even though it's not a book on business partnerships, has a lot in it that's valuable advice in terms of determining people's roles. I mean, it actually does have a section on, hey, what if you have a business partnership? I think equally as good is the 5 dysfunctions of a team.
Oh
just
man,
in terms of what's got to happen for hygiene.
Yeah, both of those are classics. 5 dysfunctions of a team, you'll be able to read through it really fast, but it's meaty. Anything that you'd add to that, Jack?
Not any that I can think of. I have a book list, but if something comes up, then I can state it next time. I was thinking
Right, cool.
for the next like part 2, and I hopefully I don't owe like John Quinones a royalty on this, but the whole "what would you do" kind of thing. So we throw the war story out and it's like, what would you do in this scenario? And then see what people have to say about it. Or maybe people have lived through those scenarios. They can tell us what actually happened.
I like that format.
Yeah, that's good.
What would you do? Here's the scenario.
Yeah.
And we can talk without names, but real life scenarios. What would you do?
Yeah, I'm gonna have to check and make sure
good.
that NBC didn't trademark that. So I'll look at that before next week or whenever we do the next.
Oh, you are
part
such
2.
a lawyer.
All right, cool guys.
All right, guys. Thank you. We'll be putting this thing up on the BGW CPA YouTube channel later on today. Anybody that came on late, thank you for joining us. We appreciate it. Good to see you again, Jack.
Yes, thank you.
And you always too, Adam.
Thank you.
See ya.
All right,
Bye.
see you guys.